Welcome back to The Explainer. Today we're jumping straight into a deep fundamental analysis on one of the most fascinating paradoxes playing out in the biotech sector right now. We are looking at Ardelyx, trading under the ticker ARDX. It is literally the ultimate financial tug-of-war. On one side of the rope, you've got this explosive, undeniable revenue growth driven by some highly successful commercialized drugs. But on the other side, you have widening net losses, a rapidly rising debt burden, and company executives who are consistently cashing out their shares. It's a wild setup, so let's get into it.
Okay, let's dive into this. Here is our roadmap for the analysis. We'll cover the RDX growth engine, weigh those revenues against the net losses, examine the rising debt burden, investigate a potential insider trading warning, look at the smart money trends, and finish up with the strengths, risks, and our final verdict.
Section 1. The ARDX growth engine. IBSRELA's massive trajectory. Let's start right off with the bull case. To understand why investors are paying so much attention to this stock, you really just have to look at this one number, 73%. IBSRELA, which is their treatment for irritable bowel syndrome with constipation, saw its revenue grow by a staggering 73% in 2025, hitting $274.2 million. And, it is not slowing down at all. In the fourth quarter of 2025 alone, the drug brought in $86.6 million. That's an incredible 61% jump compared to the exact same period the year prior. Plus, their other commercialized product, XPHOZAH, finished 2025 with an additional $103.6 million in revenue. So we're talking about some serious top-line momentum here. And that momentum is exactly why Ardelyx management has planted a massive flag in the ground. They are officially projecting that IBSRELA will achieve $1 billion in annual revenue by 2029. Now, for a commercial-stage biopharmaceutical company of this size, achieving a billion-dollar run rate on a single drug, that's a monumental milestone. It's the kind of thing that establishes a massive economic moat, just like Warren Buffett looks for, right in the chronic constipation market. They're expanding their patient reach, they're pushing deeper into the market, and prescription pull-through is improving. So the top-line growth narrative, it is incredibly strong.
Section 2. Revenues versus net losses, the cost of growth.
But, as we know in biotech, top-line revenue really only tells half the story. We have to pivot and look at the friction point of this narrative. What is this massive growth actually costing the company? Now, what's really interesting about this slide is the total disconnect between revenue growth and profitability. You can clearly see that total revenues jumped significantly from $333.6 million in 2024 to over $407 million in 2025. But look down at the bottom row. The net loss actually widened from $39.1 million to $61.6 million. Why? Because selling, general, and administrative expenses, basically the cost of marketing and distributing these drugs, skyrocketed to $337.2 million. So the cost of acquiring that revenue growth is currently outpacing the revenue itself. If we look directly at the raw SEC data from their condensed statements of operations, you can see this dynamic playing out line by line. On top of those SG&A costs, research and development expenses also grew from $52 million to over $71 million. And we should pause there for a second just to absorb that R&D cash burn. They are aggressively investing in their pipeline, like their new NHE3 inhibitor program. The main takeaway here is that Ardelyx is heavily prioritizing market capture and clinical development over near-term profitability.
Section 3. The rising debt burden, a leveraged balance sheet.
So if a company is generating massive revenue but still losing $60 million a year, how on earth are they financing it? That brings us to our next crucial lens, the balance sheet, and specifically their leverage. And this brilliantly illustrates the situation. Now, Warren Buffett teaches that manageable debt is absolutely crucial for a healthy business. But look at this trajectory. What you're looking at is the timeline of Ardelyx's debt-to-equity ratio, which is just long-term debt divided by stockholders' equity. Back at the end of 2023, they had a very manageable ratio of 0.78. But by the end of 2024, it nearly doubled to 1.52. By the end of 2025, it crossed into territory above 2. And by the first quarter of 2026, it hit 2.40. The company's debt profile has literally tripled relative to its equity in just over 2 years. Now, to be perfectly clear and impartial here, Ardelyx is well capitalized to handle this in the short term. At the close of 2025, they were sitting on $264.7 million in cash and short-term investments. However, their long-term debt closed the year at roughly $202 million, and according to that Q1 2026 data, it continued rising toward $360 million. It's a very delicate balancing act. Sure, they have the liquidity today, but that expanding debt profile means they absolutely must hit those future revenue targets to service these obligations.
Section 4. Insider Trading. A warning? Following the executive moves. Which brings us to what is probably the most intriguing part of our entire analysis. When you have a company projecting $1 billion in revenue, but they're carrying rising debt and widening net losses, how do the executives inside the building behave with their own money? To analyze this, we have to apply the famous Peter Lynch lens. The legendary investor famously said, "Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise." You know, executives might sell to buy a house, pay for their kids' college, or just to diversify for taxes. But a consistent pattern of heavy selling across the executive suite with very little buying, that is a data point investors always want to monitor.
So, the crucial point here is this highly consistent pattern of sales by Ardelyx's president and CEO, Michael Raab. Look at this. Over the spring of 2026, we see a steady drumbeat of liquidations. $243,000 in March, $261,000 in April, another $261,000 in early May, and then over $343,000 later in May. That is over $1 million cashed out in just a few short months. And the SEC Form 4 filings show he is definitely not alone. The Chief Commercial Officer, the Chief Financial Officer, and the Chief Patient Officer have all executed systematic sales during this exact same period. Viewing this through the Peter Lynch lens, this lack of insider buying confidence is definitely a glaring red flag.
Section 5. Institutional smart money trends. The battle of the funds. While the insiders are selling, we need to zoom out and look at the macroeconomic picture. How are the massive Wall Street institutions, the hedge funds, the asset managers treating Ardelyx stock? Well, this chart tells you exactly who is really in the driver's seat. Institutional investors control a commanding 58.92% majority of Ardelyx stock. If you're a retail investor watching this, you're kind of just along for the ride. It's the sentiment of these massive funds, the smart money, that will ultimately dictate where this valuation goes. And right now, Wall Street is engaged in a massive tug of war. Over the last 12 months, 129 institutional buyers injected $162.15 million into the stock. But at the exact same time, 85 institutional sellers pulled $147.30 million out. It is an incredibly tight battle. Mega funds like Vanguard and First Trust Advisors are actually adding to their positions, while others like Janus Henderson and Marshall Wace are aggressively paring back. The institutions are completely divided on whether that amazing top-line growth justifies the bottom-line debt. Section 6. Strengths, Risks, and Verdict. The final synthesis. We have covered a ton of ground today, looking at both the incredibly promising commercial data and the somewhat concerning financial and insider data. Let's move to our final synthesis and see how this all builds together. On the bull side, you simply cannot ignore a drug growing 73% year over year. The trajectory toward $1 billion revenue target for IBSRELA by 2029 is a massive value driver, and institutional inflows are still slightly edging out outflows. But on the bear side, the cost of that growth is undeniably steep. We've got expanding net losses, a rapidly climbing debt-to-equity ratio that hit 2.40, and a steady stream of heavy insider selling. It raises some very legitimate questions about long-term profitability and shareholder dilution. So what does this all mean? Ardelyx is caught in the ultimate tug-of-war between commercial triumph and financial leverage, with revenues soaring toward $1 billion, but the insiders deciding now is the best time to cash out. Is Ardelyx gearing up for a massive biotech breakout, or is it a debt-laden trap waiting to be sprung? Whether you prioritize the massive growth potential of $1 billion drug or require the strict margin of safety that Benjamin Graham preached, well, that is the question you have to answer for your own portfolio. Thanks so much for joining us for this explainer. Keep learning, and we'll see you next time.